The International Monetary Fund estimates that the impact of the COVID-19 pandemic will cost Nigeria and other oil exporters in Africa a total of about $34 billion in revenue. The projected decline in revenue is attributable to the dwindling global crude oil prices, and this was by IMF's Director, African Department, Abebe Selese, at the African Ministerial Roundtable on COVID-19 impact on the energy sector in Africa last week. Joining me now to look at this is a senior analyst for sub-Saharan Africa at Duckerfrontier, London, Matt Kiniger. Hi, Matt. Good afternoon. Good to see you.
Hi, good afternoon. Good to see you too. Thanks for having me on the show.
You're welcome. Well, the oil price collapse this year represents a severe shock to public finances for major oil producers, especially Nigeria and Angola. How have governments in these countries responded, and what can businesses expect from fiscal policy through 2021?
Yeah, so as you say, Nigeria and Angola have experienced the most significant disruptions to their budget plans as a result of the oil price crash. We've already seen the Angolan government say that it will revise down its budget this year. We are waiting for clarification on its budget plans for 2020. But overall, we expect deep cuts in spending and investment this year, followed by a bit of a stabilization in 2021, because we are expecting oil prices to stabilize here at Duckerfrontier. Looking at Nigeria, we've already seen the government pass a revised budget, which has resulted in a reduction in capital spending, or the investment budget. But looking into 2021, we are expecting continued reductions into investment and recurrent expenditure. And this is because the oil price shock will have quite a significant effect on the government finances this year. It will be forced to divert more of its spending and its resources to financing its deficit. And so this will squeeze the funds available. In terms of what we expect going forwards from government policy, from fiscal policy, so both Nigeria and Angola will see tax rises this year and into 2021. And this is because governments will try to stabilize their fiscal position. But also, this sort of oil price shock has provided impetus to both governments to really reform their tax base and diversify their oil revenues. So quite a significant amount of change coming, I think, from a fiscal policy perspective over the next couple of years.
Now, there are several other smaller oil producers in Africa that, until recently, were benefiting from healthy oil revenues. How will the weaker oil price environment affect growth prospects for these economies?
Yes, that's right. So there are a number of medium-sized economies, especially in West Africa, that will be most directly adversely impacted by the decline in oil prices. Ghana is a very good example. They were planning a large expansionary budget this year in anticipation of healthy oil revenues. A lot of this was going to be directed towards capital expenditure ahead of the election that is planned later this year. But because the government is fighting an election, it's unlikely to cut spending and investment significantly this year. So we are going to see quite a severe expansion in its budget deficit, followed by probably austerity next year. So a bit of belt tightening next year. Côte d'Ivoire, on the other hand, is probably going to trim its budget, but because it has fairly stable government finances, it probably won't severely cut spending or investment. In contrast, Cameroon is probably going to be more directly affected. We are expecting the economy to tip into recession this year, partly because of weaker oil revenues. And another country worth mentioning is Senegal. Senegal was tipped to start oil production in the next couple of years. There have been major oil finds off the coast of Senegal, but the Senegalese president has just announced a couple of days ago that he expects oil production to begin a lot later, so by 2025 or a bit later. So this will mean that growth in Senegal, economic growth in Senegal, will remain lower for a bit longer than previously anticipated.
Now, given the importance of oil exports as a source of foreign currency revenues for countries across West Africa, what can we expect in terms of currency movements over the coming months?
Yeah, so across West Africa, we are expecting severe downward pressure on currencies, especially amongst the major oil producers. Angola really stands out. You know, the central bank has allowed the kwanza to be traded in a more flexible way. It's allowing the market to set the value of the kwanza, and we are expecting the decline in oil prices and oil revenues to push the kwanza to below 600 per dollar by the end of this year. Ghana is another country that is being affected by the loss of oil exports, so we have some quite significant volatility in the CD, but the central bank, the Bank of Ghana, has intervened to stabilize the CD. CFA franc countries like Cote d'Ivoire and Senegal are a different situation, of course, because their currency is pegged to the euro. But the big story for those markets is that we are expecting to see a delay to the implementation of the new currency, the ECO, for West Africa, for Francophone West African markets. And this is because the central banks are are focusing on stabilizing the economies, and they don't want to spook investor sentiment this year.
Now, last week, Nigeria's central bank weakened the Naira at retail FX auction in a move to align the rates. What's your take at Duckerfrontier, and what would that mean for foreign capital inflow?
Yes, the central bank is really is making a number of moves to reform the exchange rate regime in Nigeria, and the stated aim is to unify the multiple exchange rates. Any sort of reform in this manner is going to be positive in terms of capital inflows. We are expecting globally anyway more portfolio investment flows, especially into emerging markets, including Nigeria, over the coming months and years. And this is because investors will be seeking stronger returns, which can be offered by markets like Nigeria. But crucially, looking ahead, we're expecting the most significant impact on portfolio flows would be if the central bank commits to a truly unified exchange rate, and one that is more set by the market. So one where it intervenes less into the exchange rate and provides confidence to investors. So that's really important looking ahead.
Thanks, Matt, for your time. Matt Kiniger is a senior analyst for Sub-Saharan Africa at Duckerfrontier. Thank you for your time, Matt.
Thanks. Bye-bye.